super gap, European super gap, 110, 2012. We have a super gap in play based on, hey, things aren't going to be so bad in Europe, and that's a bull gap. Price volatility, we said over the last week, was going to return to the 2012 calendar year. And you can't verify it until you have triple digit gap in the Dow, and it has to be triple digits, over 100 points up and or 100 points down. You have the super gap in gold today, up 28 handles. You got the CAC 40 up 83 at 32.1136. You got the DAC up 156.66 at 61.73.89, 2.6%. The FTSE plus 85, 1.52% at 56.97.50. S&P futures in the U.S., 1340 plus 105, 1289 right into the Emini futures that I have right here. Dow futures, 112, 12,449. Nasdaq futures, 2300 going into the 2369.75 plus 0.9%, or 0.98% gap. And gold, 1.77, all based on what? All based on what? Europe. And the Europe chatter. And I've covered where the S&P had started its major resistance levels the other day, and we'll be updating these indexes, and we are in an earnings season. However, you can see here clearly in the U.S. market that these futures were at 1280, which was yet a major resistance level in the S&P index 500 now, and you have topped, and you can see how they went right up here in this channel this morning during pre-market and early hours, and you can see here the dips were bought, and then you had another leg right up to the golden key area now, 1290. Okay. And one thing about the indexes on the S&P 500 is it's clearly going to gap up today, and it's going to be challenging its other highs, which on a 3-minute chart, that's what this is. That's that 1284 area. So that's going to be that trend line on a 3-minute chart. All right, we'll get into the daily charts and things like that. So one thing about the Nasdaq 100 futures is they too have risen. You can see the channels. You can see it's contributed to Europe. You can see the amount of pullback in the E-mini Nasdaq 100 pre-market futures on 110. Okay, I've already gone over what MMT's key specifically about the trade managements, what we're looking for now at the next level of resistance. Price volatility is here to stay for the calendar year. And price volatility is equally weighted to the upside as it is to the downside. So you have bear volatility gap downs and you have bull volatility gap downs. So there is some good news. Once again, the MMTs understand the psychology and how they try to build sentiment, but we're looking at key exhaustion gaps for reversals, meaning that the super gap that's going on and all of the things I just talked about is how that they would sell up there at those highs. And another thing we're looking for on day 10 is where is that bull side, buy side, on balance volume is very, very important because there hasn't been any on balance volume buy side in my view yet in this year. We'll see if there's going to be any today on the gap or not as we have it, or is it going to be a sell side volatility gap? We will measure those top end resistance levels at its very finest resistance points. The on balance volume has not been in this tape in 2012 to the upside. That would suggest that your bull is raving on a buy side and sell side tape. The thing that I will say that it's the first calendar 2012 triple digit volatility gap. And the triple digit volatility will remain at high warning elevated levels on a day-to-day roller coaster. One day you'll be gapping up, and the next day you'll be gapping down, and there's going to be a significant increase in price action volatility. How do we know? We know that the higher up that you get from the original low there in calendar 2011, and you take that low and you take where this gap is this morning, and you get right in there and you look at that upper level, you're going to want to see if that bull wants to pile drive it through there or not, because it's going to take buyers from the gap. Yes, the shorts that were built up on the market are going to get squeezed on the opening bell, but does that bear have any fear to really want to cover those shorts on individual equities that they have and indexes or whatever that they want? I think rather not. And any increased on balance volume, we would contribute it to the short squeeze against the bull bear raid. So when the bull gaps it way up, that's called a bull raid on the bear. And when the bear gaps it way down, well, that's a bear raid on the bull. And then transactions start happening after this event has already taken place. We're going to open up in 9 minutes. And I can tell you right now that looking at the 3-minute chart here, is understanding where that upper end of level of resistances are going to clearly hold, and are people going to sell. Let us not forget that the bellwether Google here, Lululemon, was upgraded and gave a better guidance picture in the retail sector. They were needing it awfully bad, but it's a Canadian company. It's not a U.S. retailer. I mean, come on. Here we are. We got a super gap here in Google. We own the call contracts. What are we going to do? We're going to buy more. They marked the call right here, 113. They marked it down $23.10, and we bought the bottom of it. And with the gap, what we're going to do is let that thing run. If it pulls back within $1.50 of our entry, we're going to look at scaling in some more, because, number one, Google is a barometer of the market because it was overbought. Yeah, we said it was a short at 670, no problem. But it fell $45 right here. And now we're going to take a look at yesterday's markdown. They marked up the puts yesterday. Look at that. And Google was showing us that put side of markets do have to be marked up. That 665 put was marked up $18 yesterday. And that was a 218 665 put. A February one, but they marked it up, and they marked up the 650 113 put yesterday on a closing level. They took it from $8.50 on the low to $29. So yeah, the put side did get a chance to get marked up. So when we get these super exhaustion gaps, super volatility, price volatility, artificial price volatility gaps, at that point in time, that buyer and seller is going to have an engagement, MMT. And that's going to show your true sentiment. We would contribute the short cover on the open on balance volume. We would contribute that volume to that group, and that crowd of people own that one in the short term in your on balance volume. If you see an increase, it's going to be coming from there. If it does 3 times normal, then you know that the bear is covering and the bull is buying. And that's how price volatility works on 110 of 2012 at 6:23 a.m. Pacific Standard Time. As we get closer to the opening, they're going to try to take the bellwether gap, try to break that freaking high. You will see exuberance. That bull was taken to the woodshed in 2011, liquidated down. Firms are firing people right and left. Margin debts at their highest levels that we had seen. And now they're trying to come back. And the exuberance of exhaustion will have to come into play at key upper resistance levels with imbalance ratios in play.